Hello everyone, my name is Dina Atta. I'm working as a petroleum engineer at Khalda Petroleum Company. I'll be your moderator today, and I want to welcome all of you for this session, and I want to welcome Dr. Ahmed Elbanbi, who will be our speaker today. Let me introduce him to you. Dr. Ahmed is a professor of petroleum engineering and the chair of department at the American University in Cairo, AUC. Previously, he worked for Cairo University. Where he still teaches graduate and undergraduate courses. Dr. Ahmed has 28 years of the diversified international experience in reservoir petroleum engineering. He worked as engineer, manager, trainer, and technology developer. Dr. Ahmed spent 12 years with Schlumberger, where he held a variety of technical and managerial positions in 5 countries. Dr. Ahmed authored and co-authored 1 book, 2 book chapters, more than 90 technical papers, and hold US patent. He has been on numerous SPE committees, program chair for 2015 North Africa Technical Conference and Exhibition, and technical editor for several journals. He is a current program chairman for SPE Egyptian section. Dr. Ahmed holds a bachelor and a master's degree from Cairo University and master's and PhD degrees from Texas A&M University in all petroleum engineering. I hope all of you to enjoy the session today, and Dr. Ahmed, the floor is yours.
Thank you very much, Dina. Good afternoon, good evening, and good night also for some of you, depending on where you're joining the webinar. What I'm going to do today is I will present an overview of petroleum economics and E&P agreements. As many of you know, E&P stands for exploration and production agreements. All right, so normally what's in petroleum economics, or what do you mean by petroleum economics? Usually people who study petroleum economics are undergraduate petroleum engineering students. And are there any differences between petroleum economics and regular economics that everyone else studies? In fact, of course, there are lots of similarities between what we do in petroleum economics and what others do in other courses like engineering economy. Even some high school students now take business classes and economics classes, and usually they cover what we call cash flow analysis. So what do we do in petroleum economics that's different from any other economics? Number one is understanding of the petroleum business. So usually in a petroleum economics course, we look into the petroleum business and what it means for petroleum professionals. There are things that are common between any economics course, if you will, like cash flow analysis. We do cash flow analysis for petroleum projects in the same way that cash flow analysis is done for other engineering projects or construction projects or any other project. We do also a bit of economic evaluation, like calculation of economic indicators, and I will cover cash flow analysis and economic evaluation in a little bit today. What's unique about petroleum economics that you do not see in other economics courses, maybe we discuss, of course, petroleum reserves and what we mean by the different classes of reserves. And as petroleum engineers and people working in the petroleum industry as G&G people as well, geology and geophysics, we are interested in evaluating reserves and classifying reserves. By the way, many oil companies, their wealth is in their reserves, how much reserves they own, how much reserves underground they own. Other topics that are related to petroleum economics is risk analysis. We emphasize in petroleum economics, we emphasize risk analysis. It is done in other economics courses as well, but we probably emphasize it more in petroleum economics because usually petroleum projects carry a level of risk that's higher than other engineering projects. Another thing that's unique in petroleum economics, or a topic that's unique in petroleum economics, is petroleum agreements. They have several names. You can call them petroleum agreements, international agreements, concession agreements. There are many names that we give to that topic. And basically, these are the contracts or the agreements that control the relation between a country and a company. A country represented by the government, and a company like an oil company. So what we'll do in this webinar is I will give a lengthy introduction on the oil business, more than a 5-minute introduction probably. Then we'll discuss 3 topics that are quickly actually related to economics, petroleum economics, Capex and Opex, capital expenditure and operating expenditure, and cash flow analysis that we do in the petroleum projects. And by the way, what we do in this regard, looking at our expenses, whether they are Capex or Opex, and of course I will define that when we get to this point. And what we do in cash flow analysis is very similar, whether we're evaluating a hydraulic fracturing job that may cost anywhere between $100,000 to maybe $2 million, depending on where you are and how big the hydraulic fracturing job is. So what we do to evaluate a fracturing job is very similar to what we do to evaluate very large projects that may cost several $billion per project, if you will. Then I will cover risk analysis in brief and what we do in petroleum economics regarding risk analysis. And finally, we will end up with the explanation of different types of petroleum agreements and how the cash flow is or runs in petroleum agreements. So we start with the introduction. My introduction here is, the beginning of it is very simple. I want everyone to read, and for those who cannot see the slide very well, so I will read it for you. It's a piece of news that was published on 3rd of November 2018. Eni estimates investment in Zohr gas processing plant, only the gas processing plant, at $5 billion. Italian Eni company has estimated the cost of implementing the Zohr gas treatment plant to be $5 billion, with a capacity of 3.2 billion cubic feet of gas daily. That's the daily production. In order to connect to the production of the project, that's estimated to be 2.9 billion cubic foot per day. That was in the news in November 2018. The total cost of a project like Zohr, which is offshore Mediterranean, in offshore Egypt in the Mediterranean Sea, in the deep water, the overall cost is more than $12 billion. And this is one project. We do have examples of very giant projects like that, and even much bigger projects like that. Several $billion for an oil company to spend several $billion in one project, this is not uncommon in the petroleum industry. So the petroleum industry has 3 main characteristics when it comes to what we do as unique features or unique characteristics for the petroleum industry that are very unique to the petroleum industry, and they do not exist in other industries, or at least the 3 of them do not exist together in other industries. So number 1 important feature here is significance. And in the last slide, I think you got a taste of what we mean by significance. Significance here means in oil projects, oil and gas projects, or petroleum projects, oil companies need to be giant companies, big companies, to be able to spend a lot of money on their petroleum projects. For example, a deep water, the cost of drilling one deep water well could be $120, $150, sometimes $200 million per well. The other feature of the petroleum industry is globalization. So in the petroleum industry, we don't really see countries that use low technology and countries that use high technology. In fact, the petroleum industry is very global. Whether the country is developed or developing, advanced country or poor country, rich country, the oil industry in every country is more or less similar. In fact, when it comes to applying technology, we see two distinct types of technology. Land technology, which is usually cheaper than offshore technology. So we see land technology and offshore technology. So offshore technology in West Africa is very similar to offshore technology in the Gulf of Mexico, in the North Sea, in the Mediterranean, in offshore Brazil. And land operation in US land is similar also to land operation in the Western Desert in Egypt, is similar to land operation in the Great Sahara of Algeria, etc. So this is what we mean by globalization here. The third characteristic is exploration risk. And this is probably the only industry that carries a very large element of risk. And this is why petroleum engineers and G&G professionals go and study a lot about the subsurface. So they can, when they become professionals in the industry, they can manage this exploration risk. Every business has its own risk. Usually the businesses have what we call operation risk. If you make the wrong decision, what are the consequences of making that wrong decision? Or what are the consequences of a device malfunctioning, for example? But in what we do in the petroleum industry, in exploration carries a lot of risk because you can spend $150 million in one well and you end up finding no oil and no gas. There have been, of course, some of you are already seniors and some of you are graduates. So you know that we have three distinct areas in our business: upstream, midstream, and downstream. Upstream is what we call E&P industry or exploration production industry. So this is where we explore for oil, develop our oil and gas fields and build our facilities and produce and babysit our wells. By babysitting our wells, meaning what I mean here is that we do everything to ensure the continuation of the flow of oil and gas from our wells for the maximum period of time. So this is what we do in upstream. And this is, of course, where petroleum engineers and G&G people work most of the time. Then we have the midstream business first before the downstream. So in the midstream business, we look into businesses like transportation, storage. So transportation, there are transportation companies like pipeline companies that transport oil products, transport also gas. And there are ships that transport, like we call them tankers, that transport the oil across seas and oceans. And there are also LNG tankers that transport liquefied natural gas. So all of this comes under what we call midstream business. Some people also categorize the processing business under midstream, and usually they mean facilities like large gas plants under the midstream line of business. Then we have the downstream line of business, where we have the refining, petrochemicals, and marketing and distribution. So businesses where we sell gasoline to fill cars is actually a downstream business. Usually, petroleum engineers and G&G people don't really work that much in the midstream and downstream, although many of them, depending on the program that you follow, are qualified to work, especially in the midstream. All right. So how do we run the business? The way we run the business is we have oil companies, and they are actually classified into different types. So we have the majors and the super majors, and these are the companies that the value, they are very huge companies, big companies. They can make every year $200 billion dollars of oil, 400 billion, sometimes 500 billion dollars of oil every year in revenue. Profits, of course, are much less than that. Sometimes these companies make in the range of 40 or 50 billion dollars as profit. By the way, 40 or 50 billion dollars is sometimes larger than the budget of big countries, or let's say mid-size countries. Examples of majors and super majors: ExxonMobil, Chevron, BP, Shell, etc. Several of them. The other type of companies, we call them independent, so they are smaller than the majors and the super majors. Examples of independents are Apache and Amerada Hess, and usually these companies are generally smaller in size. This is number one. And number two, they usually focus on the upstream business. The majors and the super majors, they have other businesses, like they do have business in the midstream and the downstream as well. Then we have another type, which is the major, what we call major resource holders, or national oil companies. Examples are, or examples include Aramco in Saudi, ADNOC Group in United Arab Emirates, Kuwait Oil Company in Kuwait, EGPC, Egyptian General Petroleum Corporation in Egypt, etc. So these are government-owned or country-owned companies. Usually they work in the different sides of the business: upstream, midstream, and downstream. And also they work as controllers or regulators for the petroleum business in their respective countries. Then we have another class of companies that's emerging. This is a newer class of companies that did not exist maybe 30 or 40 years ago. We call them government-sponsored enterprises. Examples will be Statoil Hydro in Norway, ONGC in India, Petrobras in Brazil. So these government-sponsored enterprises are actually private companies in essence. So anybody can buy shares in these companies. However, the majority of the stocks or the shares of the company are owned by the government. So they have some autonomy when it comes to making decisions, but also the major stakeholder in the company would be the government itself. Then we have integrated service companies. These companies are service companies that are very big. Examples of that are Schlumberger, Halliburton, and Baker. These companies provide services to the oil companies in many different services to cover a very large spectrum of what oil companies do. Then we have specialized service companies, and the specialized service companies like drilling companies. Many of the drilling companies are specialized. They specialize in one service, which is, for example, drilling. Then we have, of course, refineries where they buy crude oil and they produce products like gasoline, LPG, liquefied petroleum gas, naphtha, etc. And they sell these products to marketing companies that sell to end consumers like you and me. We also have petrochemical or chemical companies. These are the companies that take oil or products of oil and gas and use this as raw material to manufacture products that we use in everyday use in our life. So there are 3,000 to 4,000 different petrochemical products that we use every day that actually come, or their raw material comes from oil or gas. Examples, bed sheets, plastics, everything that comes from plastics or fibers is actually coming from oil or gas. And by the way, this is probably good news, because at least 12 million barrels of oil, of the oil that we produce every day worldwide, goes into plastics, into manufacturing of plastics. Then we have the transportation companies like pipeline companies and shipping companies. So this is basically how the oil industry or the oil business is run. Let's look at a few statistics here, a few charts. What you're looking at now is the world oil production and reserves. So you can read the reserves using the green line here, and you read it from the right-hand side. You can read the production from the left-hand side. And actually, we're plotting here the production and the consumption, production in blue and the consumption in red. These numbers are as the end of 2018. So in 2018, we were producing around 100 million barrels of oil every day. What's really interesting here to see is no matter what happens, the oil production has grown with time. And interestingly enough, the reserves have also grown with time. So every year we produce more than what we produced the previous year, and we find more than we produce as well. So reserves are increasing, oil production is increasing, and oil consumption is increasing. What's the story in gas? In gas, again, consumption and production are given in red and blue. We produce around 370 billion standard cubic foot per day. And when we look at the reserves here are given in green. So reserves are 7,000 trillion cubic feet of gas. What's interesting here is that over the past many years, gas production and gas consumption are both, of course, increasing, and reserves of the gas is also increasing. And this means that as an oil industry, we're good in replacing what we produce and consume. So every year we can replace what we have used the previous year. So for those of you who are anxious because the oil price is falling and all of that, I just wanted to show you these statistics, and these are facts. There is no projection, there is no forecast here. These are the numbers that we have seen over the past 60 years. All right. Now, where is oil and gas in comparison with primary energy consumption worldwide? So what do we mean by primary energy? Primary energy includes oil in green here, natural gas, nuclear energy. So this is how much nuclear energy we consume every year from 1993 all the way to end of 2018. Then hydroelectricity in light blue here. Then renewables, and renewables includes everything you hear about, includes solar energy, includes geothermal. Of course, geothermal, there is big room for the petroleum professionals to work in the geothermal industry as well. And it includes wind energy and biofuels. So all four of them together are what we call renewable here. And this is their share of the primary energy consumption worldwide. Interestingly enough, coal, which is supposed to be twice as polluting as natural gas, is still growing. Why do you think every source of energy is growing in consumption? We produce more of it every year over the previous year, and they are all growing despite the fact that some of these primary sources of energy are actually polluting, and they pollute the industry, especially coal. The reason is that actually two reasons. One is the growth in population. So today the world population is around 7.8 billion people, and every year we add more people, of course. This is reason number one. So we need more energy. Reason number two is urbanization. With the increase in the standard of living, every one of us consumes more energy. Therefore, we need more energy. So it's not only the population growth, but population growth and the other important factor, which is each one of us uses or consumes more energy when the standard of living goes up. Shares of global primary energy consumption, we need to understand a bit on what's happening and what has happened over the past years. This covers 35 years from 1985 to today, or to 2018. So when we look at the oil share of consumption, so please, I don't want anyone to be confused here, because this is percentage of total. This is not how much oil we consume. So how much oil, it has been growing. How much oil we consume every year, it has been growing. But the share of oil in the energy mix has been declining a bit. So it was 50% here in the 80s and early 90s. It was around 40% in the 2000 to maybe 2010. And it is decreasing a little bit to maybe around 35% of the energy consumption worldwide in the recent years. And by the way, this matches very well with oil price. So when oil price increases, oil price increased here, as you will see in the next few slides. When oil price increased, its share of energy use worldwide has decreased to that level. Again here, oil price started to increase from 2008 again, and it reached levels that were very high from 2008 all the way to mid 2014, and this is why the share of the oil has gone down. And some other energies are compensating the share, but not the quantity. And I'm making this point one more time. The quantity of oil has been increasing year after year. The quantity of oil consumption has been increasing year after year. What has been reducing is the share of the oil in the total energy. If you look at the gas has been growing in quantity and in its share of the total energy consumption. Hydroelectricity, as you can see, is more or less constant, less than 10%, by the way, we get from hydroelectricity. Nuclear energy has gone up a little bit to maybe 6 or 7% of energy, and has gone down in the recent years to 5 or 6%. Renewable has been growing steadily, and now it is around, let's say, 5% of the total energy consumption. What's the other big elephant? Is coal. This is the share of the coal in the total energy mix worldwide. This slide is related to what I was talking about. Why do we need more energy? We need more energy because every individual consumes more energy year after year. When we consume more energy for air conditioning, for transportation, etc. So if you look at the energy consumption per capita, energy consumption per individual, in North America, this is the level of North America. Then this is Europe, the dark blue, the light blue, and the magenta here is total CIS. CIS is the former Soviet Union countries. The Middle East countries have been growing, so they are now in the range of the former Soviet Union and the range of energy consumption in Europe as well. And there are other regions that have less consumption per capita or less consumption per person. These regions include South and Central America in green here, Asia Pacific in yellow, and Africa at the bottom here in red. So of course, the expectation over the next 10, 20, 30 years that all of these countries and all of these regions will catch up to the middle here. And this means more energy demand and more energy consumption. I believe many of you have seen this slide or similar slides before, and let me spend 1 or 2 minutes on this slide to make sure everyone understands what we're looking at here. So this is the oil price. That's oil price, not gas price. Gas pricing is a little bit more complicated because there are different prices for gas, because gas is difficult to transport and store. Oil is much easier to transport and store, so we can have an average oil price, worldwide average oil price. Of course, there are differences, slight differences between West Texas Intermediate, Brent, Gulf of Suez mix, Arabian Light. There are different standard oils that we use, and they have slightly different prices, but all of them are within few dollars from each other. So there are two curves here, the dark green and the light green. The dark green is the actual oil price dated back to 1861 all the way to last year. And the light green is the oil price corrected with inflation. So what does that mean? So let's take a particular year here, 1980, for example. 1980, the oil price was maybe $36 or $37 per barrel back in 1980. But it felt for the consumer as if it were sold for $115 per barrel. You can look at it in a different way. What we used to buy in 1980 for $37, to buy products for $37, in today's environment, I need to pay $115 to buy the same products that we bought back in the 1980 for $37. So the light green is what you really need to look into, or what you really need to look at. This is how it felt back then for the people in the 1980s. This is how the price of oil felt to them. So you can distinguish here three peaks of oil price. This very old peak, and I'm not going to talk about it because that was very old. And the other peak here, you see the peak coming up here. Actually, that was 1973 when the oil embargo, because of the war between Egypt and Israel. So, and the Arab countries got together and they had the oil embargo. So the oil price spiked up. The other spike here is due to the Iranian revolution. So these two spikes made people back then feel that the oil price was at that level. Look at the other part of the curve, starting from 2006 maybe, or 2007, all the way to the mid of 2014 when the oil price collapsed. Okay? So we have this peak and we have this peak. Currently, of course, the oil price is around 35. So it went up to 60, 70, then went back in the last, after the pandemic, of course, to 30 or $35 per barrel. Interestingly enough, if we look at the petroleum engineering enrollment in universities worldwide, and this is the data from the US. So in the first period from 1973 all the way to 1984 or 86, when the oil price collapsed, this is how many students we had in American universities studying petroleum engineering. Then we had these numbers for a while, and starting from 2006 all the way to 2014, we had the other peak in people studying petroleum engineering. I don't have the statistics for geology, I'm sure the geology follows a similar trend, but not that sharp. Why? Because many geologists, actually graduates from geology, they don't work for the petroleum industry, but they work for other industries, but they are very much affected by the oil price. So hopefully with that, we see, actually, it's interesting to see that these two peaks match exactly with the two peaks in price here. And of course, the future remains to be seen. I don't like to use or to present forecasts in general, so I only have one forecast slide. And this is coming from BP Energy Outlook. Of course, in forecast, nobody knows what will happen in the future, but they work on different scenarios. So the scenarios that many people believe in, this is where we are today, 2020, around 2020. And this is looking ahead, like 20 years ahead. If we look at the share of the oil, it is expected to decline a little bit. The share of the gas in the total energy mix is going to grow. The share of the coal is expected to decline. And the share of the renewable is expected to increase. Now, please do not mix between the share of the energy source and how much energy is going to be used. If we look at how much oil do we need in the future, we actually need more oil than what we have today, than what we produce today. If we look at how much gas we need in the future, we need more gas than what we produce today, which means we have to keep spending and exploring and finding, and we have to keep improving the technology that we use so we can go back to our mature fields and extract more oil at lower cost. I'm going to move now to petroleum economics, and we'll look at Capex and Opex and the cash flow analysis. So we discussed in the beginning that we have, of course, upstream business, midstream business, downstream business. The majority of the risk of the petroleum business is actually focused in the upstream side of the business. And when we look into details of the upstream side of the business, usually the petroleum projects, the life cycle of petroleum projects goes through the following. Exploration. So in the exploration phase, we shoot seismic and we drill usually 1 or 2 or 3 wells until we discover oil. So these are the two main activities. So we shoot seismic, we acquire seismic data, process seismic data, interpret seismic data, and we drill usually one well, which is the exploration well. Then we have the second phase, which is the appraisal phase. In the appraisal phase, there are 2 activities we do as well. Activity number 1 is drill few wells. We call them data wells or appraisal wells. These wells are expensive wells because we cut core, we run all the logs, we drill them to acquire information. We drill them to learn about the reservoir. We don't optimize the cost that much during drilling appraisal wells. We drill them for data mostly. The second activity under appraisal is what we call field development plan. So we take all the information that we gathered during the exploration phase and from the few appraisal wells, and we write down or we generate our field development plan. So in this field development plan, we decide how many wells we're going to drill in the entire field. What kind of wells? Are they vertical wells, deviated wells, horizontal? Are we going to frag the wells? We're not going to frag the wells. We make lots of decisions when we do this field development plan in the appraisal phase. Are we going to inject water or not? I have to make these decisions. What size of surface facilities do I need to build? How am I going to take the oil or the gas to the market? Through pipeline, through trucking. So we have to solve all of these questions in the appraisal phase. Then we generate the field development plan. So again, appraisal wells and the field development plan. Then we go and develop. there are two activities in development. Number one is drilling the rest of the wells. Could be tens of wells, could be hundreds of wells. So drill and complete our development wells. And the second activity is build our surface facilities and pipelines and flow lines. So the two activities here are drilling and surface facilities. Then we go into the production phase. In production, we do lots of activities to babysit our wells and to ensure that they produce for very long period of time. And sometimes also we go into upgrading facilities, we go into redevelopment sometimes by drilling infill wells, additional wells, etc. So usually we spend a few years in exploration, let's say 1 to 3 or 5 years. Then in appraisal, usually 1 to 2 years. In development, usually 1 to 2 years. And production, hopefully, we stay in production for a long time. Usually 30, 40, 50, 60 years sometimes. The life cycle planning, when we look at economics with that life cycle, so in the exploration phase, we spend the money. By the way, these circles here, these blue circles here, are what we call final investment decisions. So oil companies at these circles, they have to make decisions. And their decisions are based on economics all the time. Their decisions are based on mostly economics. What we're looking at in the on the y-axis here is the cumulative cash flow. So basically, what is cumulative cash flow? It is revenue minus expenses, and we cum it every year. So in the exploration phase, we drill, we acquire seismic, we process seismic, so we spend the money. So it goes to negative here. Then after exploration, if we have a discovery, we go and drill appraisal wells. So another expense. And we study. While we're studying, the cash flow is, studying is cheap, drilling is expensive. So we generate the field development plan, and then we go into the what we call primary development. So here we drill a lot of wells and we build our surface facilities. So we spend a lot of money. Then at this point, we hook up our wells to production and we start selling the oil or the gas and we start making some money. So this is why the curve goes upward here and all the way, and hopefully we make more money than what we spend. Sometimes we continue producing and sometimes we continue producing, continue making money, and sometimes we go into what we call redevelopment. So we take another capital expenditure, another major capital expenditure for infill drilling, for example, or for installing water injection facilities. So we take another negative expense, and hopefully this negative expense will make us, at the end, will make us more money than what we spend. Then at the end here, we have to abandon the fields that we produce. So we spend money on abandonment, our wells and our facilities. There are few measures of economics that we look at from this cash flow analysis, if you will. One of them is what we call here ultimate cash surplus. So actually, what is ultimate cash surplus? Profit is revenue minus expense at every time step. The time step could be every month, could be every 3 months, could be every year. So if I look at yearly profit, then I take the revenue of the year minus the expenses that the oil company incurred during the year, and the difference will be what we call profit. Ultimate profit is the entire profit of the project. So we take all the expenses of the project over 40, 30, whatever number of years, and we take the revenue over the duration of the project, and the difference between them will be the ultimate profit. If you want to appear smart, instead of using ultimate profit, you can use ultimate cash surplus. So this is another term for profit. There is an important economic parameter that we calculate, and it is very important for oil companies to manage, which what we call exposure. And the exposure here is the maximum negative number. So what does that mean? Oil companies, like any other venture, have to bring money from outside sources to spend on their projects. So how do they bring money? They either take loans from banks and financial institutions, and the other way is to sell stocks in the stock market to individuals, and the individuals will buy these stocks and give the money to the oil company so the company can carry out their projects. And of course, the individual will be a minority owner in the oil company. So exposure here means the maximum negative, and companies have to manage their exposure because this is the part where, or this is the time when the oil company is weak, if you will. They owe money to financial institutions, so someone else, another oil company or another business, can come and buy them at this time. So they have to manage their exposure. They cannot have all their projects, the exposure time for all their projects occurring within 1 quarter or one particular year. All right, let's move now to what we mean by Capex and Opex for the oil business. Capital expenditure, these are the expenses that lead to the creation of capital or the creation of assets which add to the capacity of the system. This is the book definition. This is the book definition. Operating expenses can be deducted from taxable income immediately, and the operating expenses are expenditures that we spend not to increase the capacity of the system. The best thing to do to distinguish between capital expenditures and operating expenses is to take an example. Capital costs for oil companies include drilling costs, completion costs, facilities construction costs, facilities upgrades. Adding perforation in a new zone will be capital expenditure. So if the well is producing from a particular reservoir and you're going to add perforation in a new zone and go and produce from a new zone, the cost of adding this perforation in the new zone will be capital cost. Fracturing in a new zone, same thing. If you're going to complete the well in a new zone, that will be capital expenditure. Let's have a look at how much do we spend industry-wise on Capex alone. So in 2014, oil price was high. So look at how much the oil industry spent on Capex, on drilling and completing wells and exploring, close to $800 billion. Then the capital expenditure has gone down because the oil price has gone down here. And this is how much Capex that was spent in 2019, close to 500. By the way, the estimates for 2020, because of the Corona pandemic, is that many oil companies reduced their capital expenditure for 2020, and I think we'll end up spending 75% of what we spent in 2019. Example for operating costs. Operating costs include transportation costs, labor costs, so salaries. All of us, all of our costs are under actually operating cost. Cost of supervision, supplies like catering and supplies for the well, for the facility to survive. Costs of operating the pumps, whether they are downhole pumps or surface pumps, to operate the pump. The pump itself is Capex, but cost to operate the pump, like fuel, will be Opex. Electricity, repairs, chemicals, and we use a lot of chemicals in the in our oil fields. Of course, it is very common for oil companies to spend a lot of money on chemicals to treat the oil and enhance its properties. Fuels is another example of operating cost and other incidental expenses. So how much are we talking about? Before we look at Capex and Opex in more details, let's define a terminology that's important for many managers in the oil industry. This is called unit technical cost. By the way, unit technical cost, you find it in every industry as well. So what is unit technical cost for us in the petroleum industry? It is the sum of capital costs and operating costs divided by the number of barrels produced or ultimately produced. The unit technical cost is often used by decision makers as a yardstick or as a measure for a first rough screening of projects. So let's have a look at unit technical costs. This comes from a consulting company actually that looked into costs in different countries. And this is the data as of 2015. This is the data of 2015. By the way, every year, these numbers change. The costs change. So in the UK, in 2015, unit technical cost was $52.5 per barrel, which means if they keep that cost, it will be very difficult to produce oil in the UK in today's environment. Let's look at the same statistics, but let's break it down into Capex and Opex. In the UK, this is the Capex and this is the Opex, and you can see Brazil, Canada, United States, Norway, etc., etc. I don't want anyone to get the wrong conclusion here that unit technical cost in the UK in 2015 was $52.5 per barrel. So in today's environment, when the oil price goes down to $35 per barrel, the UK is going to shut down their operation. No, this will not happen. We actually shut down a project or shut down operation in an oil field when the operating cost is higher than the oil price. So when the operating cost alone is higher than the oil price, we shut down the operation. So which means none of these countries here will shut down entirely their operation. But another thing to notice here is that this is, of course, average number. So this consulting company took all the costs in the UK and all the production in the UK, and then divided the cost by the production. There are projects in the UK that cost much less than that, and there are projects that cost higher than that. The high cost projects, expect them to shut down when the oil price goes down. And this is why we see cycles in the oil price. So when the oil price, when the supply is low, demand is high, oil price goes up. So when the oil price goes up, oil companies find, or they make more money and they spend more money and they invest more money into oil projects. So oil becomes abundant, then the oil price will go down, and so on and so forth. Of course, these cycles take years to happen. Currently, we are in one of our down cycles. So it's actually better to be starting your career in a down cycle because it will go up. If you're starting your career in an up cycle, then it will, at some point in time, it will have to go down. Economic yardsticks that are important for oil companies. Every oil company carries at least these yardsticks or economic measures. So for every project they do, they look at profit, payout, exposure, cost to find and develop reserves. And these are the important ones that do not consider the time value of money. There are other measures that consider the time value of money, including rate of return, net present value, and discounted profit to investment ratio. In particular, these three, plus cost to find and develop reserves, we call them the big four. So in any project we evaluate, in any upstream project we evaluate, we look at these four. These three plus cost to find and develop reserves. You can look at more economic yardsticks, but at least these four. So what is the definition of cost of finding and developing reserves? Cost to find and develop reserves is equal to investment in finding, which means exploration and development, divided by how much reserves we can book. And usually it is the proven reserves that we look at when we look at the cost of finding and developing reserves. There are variations of cost of finding and developing reserves. Sometimes we look at finding cost only. Who's really interested in looking at finding cost? Exploration department within oil companies. So exploration departments looks at how much they spend on exploration divided by how much reserves they find. Operations department, so you can look also at only development costs. So usually this considers development costs, the Capex that we spend, drilling wells and facilities, required to develop reserves divided by how much reserves we find. So you can look at only development cost if you want. Let's review quickly the time value of money. I will not spend too much time on that because many of you have done this before, but for those who have not, let's think about what we mean by time value of money. So which would you choose? If someone is giving you $100 now or $100 2 years from now, I think everybody will choose to take the $100 now. But if someone is making a better deal, if someone is giving us $100 now or $700 2 years from now, I think the majority of us will say, I will take the $700. I will wait for 2 years and then take the $700 instead of taking $100 now. But if someone is asking you, would you take $100 now for a service or for something that you did for me, or $140 or $130 2 years from now, then it becomes very difficult to decide. If you trust the guy, you may wait and take the larger value of money after 2 years. If you don't, of course, you will take the $100 now. So sometimes it's very difficult to decide, and the time value of money helps us make that decision with calculation. So what is time value of money? Any future money that I will receive, so future value, FV for future value, means something to me now, or it feels something now. It has a present value. So how do we convert from present value to future value, or from future value to present value? We use this magic formula here, which is a very simple one. We take the future value divided by 1 plus I here is the interest rate or the discount rate, to the power n. And n is the number of periods here. So if I'm I and n, they need to go hand in hand. So if the interest rate is 10% per year, then n here will be yearly time steps. I will take the money every year. So this is how we move from present value to future value, or from future value to present value. There are 3 measures that are important for us in the petroleum industry, and they use the time value of money concept. The first one is what we call net present value. So in the net present value, we take revenue every year or every quarter. We take revenue minus expenses minus investment, the capital. Expenses here is the operating cost, and I here is the investment or the capital cost. So we take, if you take revenue minus expense minus investment, this will be the profit for the year. Then you discount it and you sum up the years. So if the project is taking 10 years, I will have 10 terms here to sum up. So this is how we compute the net present value. So basically in petroleum projects, because they are usually long-term projects, 40, 50 year project, we spend money in the 40 or 50 years, and we also make money in the 40 or 50 years by selling the oil and the gas. So we take all of this money every year, and we bring it to a common basis, which is the net present, which is the current time that we're talking about, then that we are evaluating the project in. So this is what we mean by net present value. There is another measure. It's called rate of return. It has many different names: internal rate of return, a nominal discount rate when present value of cumulative net cash flows equal to 0, earning power, also real-time earning power. So it has different names. So what is it? It is the interest rate that makes the net present value equal to 0. So there is a value for interest rate here that makes the net present value of the project equal 0. And this rate of return has to be much higher in a risky project, has to be much higher than the interest rate that you could earn if you put your money in a bank, if the company puts their money in a bank. So the acceptable rate of return anywhere in large petroleum projects actually depends on the project. If you're looking at hydraulic fracturing a well, whether I want to hydraulically fracture the well or leave the well producing without hydraulic fracturing. So if we're talking about a small project like this, like completion of one well, we would like this rate of return to be higher than 25%, 25 or 30 or 35%. If you're looking at a very large project like development project that will cost $5, $6, $7 billion, maybe you can live with a rate of return that's in the range of 20%, 25%, lower range of rate of return. Another important measure here is the discounted profit to investment ratio. Another name for it is discounted profitability index. So what we do here in this ratio is we calculate the net present value and we calculate the net present value of the investment, net present value of the capex that we will spend over the next 30 or 40 years. So we take the net present value of the project divided by the net present value of the investment, and that will give us a ratio. And this ratio will be, there are variations of this measure, by the way, but this should be above 1.2 for the project to be good. And again, in very large projects, we may sanction or we may approve a project that has discounted profitability ratio of 1.2 or 1.25, sometimes even 1.15. But in smaller projects, we want this discounted profit to investment ratio to be much higher than that. Okay. I will move now from Capex and Opex and economic evaluation to risk analysis. This is something that's very important for us in the petroleum industry because we understand that upstream projects carry a lot of risk. So what do we do in risk analysis? There are many risks in the petroleum industry, and oil companies over the years become very, very experienced in managing these risks. So there are financial risks, and these risks focus on short and long-term property and revenue loss and investment returns. This what makes oil companies have a sizable group that looks into planning of future projects and makes sure that they manage these financial risks, including the risks associated with the fluctuations in oil prices. There are also other risks that we have to worry about, like in any business or in any project that has operation, safety risks. So the safety risks, they focus on human safety and accident prevention, mainly within workplace boundaries. And safety risks are hard to estimate quantitatively. Of course, you cannot put a dollar value against injury of one of the employees or death in an accident. You cannot really put a dollar value against that. So it is very hard to estimate quantitatively. Environment risk, and these are huge risks. They focus on the effects of human health as well as ecosystem impacts, and the focus is on liability and insurance. So liability and insurance, we would understand what we mean here when we think about Macondo accident, for example, in the Gulf of Mexico, I think in 2010, when an oil well had a blowout, and the companies involved actually spent more than $60 billion in what we call consequential damages to compensate people who were involved in the accident, and people who had environmental issues afterwards, like fishermen, for example, in Louisiana. So what is risk analysis? So we understand there are many risks that we are exposed to in our business. So what is risk analysis? Risk analysis is a process. So it's a process of estimating the probability of occurrence of an event and the magnitude of the adverse effects. The adverse effects could be financial loss, could be safety issues, could be health and ecological over a specified period. Risk analysis aids decision-making. So the oil company makes decisions based on what they do is they do economic evaluation first, and then they evaluate the risks associated with oil projects. And hopefully with this process, we can minimize the losses that we may have incurred if we don't do the risk analysis. So there are several methods for risk analysis. They are actually, all of them are very simple methods. The simplest one is sensitivity analysis. So we change one of the inputs in our economic calculations. So for example, we're calculating the net present value. So we change one of the inputs is oil price. So we change the oil price in the future, and we see how much impact the oil price would have. I can also change the cost of drilling a well. Let's say it's $10 million, and it might be 12. So it might be 8. So we calculate the net present value when the well cost is 8 and when the well cost is 12, and we see the impact on the net present value or the rate of return of that changes. How do we do the sensitivity analysis? Doing the sensitivity analysis is easy. We change one of the inputs and we look at the new value of the output. So one of the inputs could be oil price, could be the cost of the well. One of the outputs could be net present value or rate of return or discounted profitability index. How do we display these or the results of the sensitivity analysis? We usually use spider diagrams and tornado diagrams, and I will show you an example on spider diagrams. Another method we use in risk analysis is expected value analysis. Here we take the expected value, for example, net present value of an outcome. If I find the oil, the net present value will be $100 million. If I don't find the oil, the net present value will be minus 5 million. Why minus 5 million? Because I spent 5 million in drilling the well. So what's the probability of finding oil? 10%. So I take the 100 million multiplied times 10%, plus the negative 5 million multiplied times the probability of not finding oil, which is 90%. Another method that we use is Monte Carlo simulation. Many of you know volumetric calculations, and in one of the applications of Monte Carlo simulation is in calculating reserves using the volumetric method. Whether you've studied G&G or petroleum engineering, you know what I'm talking about. Another application for Monte Carlo simulation is actually in economic analysis of petroleum projects. So what we do in Monte Carlo simulation, when we evaluate a project, we build the economic model, the cash flow of a particular project, and then we go and tell a program to vary the oil price, the cost of the well, the decline of the well production, vary any parameter that goes into the economic calculation, like input into the economic calculation, and calculate the variation in the output. And then we display that with the S-shaped curve, and we can find the range of outcome. So for example, if I run Monte Carlo simulation for a particular economic evaluation for an oil project or a gas project, I will get the NPV, the net present value, as a range with probability. So the NPV will be anywhere between, let's say, 150 million to 200 million dollars, but the probability of 150 million is high and the probability of 2 million is low. For example, if the oil price increases, I will make 200 million. If the oil price stays as it is, I will make 150 million. So something like that. And we can do that very quickly with Monte Carlo simulation, but it requires, of course, the use of a computer program. Anything else you can do by hand, but Monte Carlo simulation, you really need to do it with a computer program. Another method we use is decision trees. And again, G&G people use decision trees a lot when they evaluate prospects for exploration. So they would rank the prospects and sometimes use decision trees to manage the risk when they have several prospects to drill. This is an example on spider diagrams. You have here some output on the y-axis. The output happens to be rate of return. It could be also net present value. This is the value of the most likely scenario. So the rate of return here is probably 18%. On the x-axis, this is called parameter change. So we take a parameter like crude oil price, we change it by positive 10% and 20% and negative 10% and 20% and see what's the impact of changing oil price on the output, which is rate of return. So if I change the oil price by 10% here, positive 10%, the impact is all of this. So the rate of return will go from the base value, which is 18% to maybe 30%. So how much increase is that? From 18 to 30%, this is more than 50% increase. So for 10% increase in oil price, I'm getting 50 or more than 50% increase in the economic measure, rate of return, which means oil price in this project is very important. On the other hand, if you look at transportation cost, if the transportation cost increases by 50%, the rate of return will go from 18% to something like 10%. So if the transportation cost in this particular project increases by 50%, which is huge, by the way, huge increase. We estimate these costs, of course, with much better accuracy than that. So if the transportation cost increases by 50%, rate of return will not decrease significantly. So spider diagrams will show us the parameters that have the highest impact. These are the parameters that have the steepest slope, and the parameters that have gentle slope will have minimum impact on the output of the project. Then the oil company would focus their effort into what matters, into the parameters that matter, not the parameters that do not have significant impact on the economic value of the project. My last section here, and hopefully you're not tired by now. I'm sure some of you are. My last section here is the petroleum agreements. So this is a characteristic of the oil business, and you do not find similar type of agreements in other business. Of course, in mining business, there are similar types of agreements, but in other businesses, you don't really see these types of agreements. So what do you mean by international agreements here? Usually in any agreement, there are two bodies. So there is one body that's represented by the state oil company or the regulation agency in the company, governmental regulation body. The state oil company, so I'll give you examples here. EGPC, Egyptian General Petroleum Corporation, is, and EGAS and Ganubi are representative of the state oil company in Egypt. So the state oil company role in this case is the following. Number one, represent ownership of the nation's resources. Who owns the minerals, who owns the oil and gas underground? In the majority of the countries, almost in every country except for maybe the US and Canada, the owner of the subsurface is people. And the people are represented by the parliament of in a country. The body that works on behalf of people, on behalf of the parliament, to make these agreements is the National Oil Company or the governmental regulation body. In our case in Egypt, it is the EGPC. So EGPC role is to represent the ownership of the nation's resources, is also to explore, produce, transport, refine, market, distribute, sell, and export nation's resources on behalf of the state, on behalf of the country. Ensure citizens' interests are not controlled by investors. How do they do this? By employing professionals, by employing petroleum engineers and G&G people who have experience, so they can, they understand, they speak the language of the investor, they speak the language of the oil company, and they can also control, regulate, and encourage operations. Act as a center of knowledge and technology for the nation, introduce knowledge technology into the local economy, and deal with investors, and also dealing with other organizations like OPEC, OAPEC, etc. What's the oil company role? The oil company has different names here in these agreements. They could be called the investor, contractor, operating company, etc. Many, many different names. So the oil company role, the primary purpose is to maximize profits and return value to its stakeholders and shareholders by finding and developing oil and gas reserves at the lowest possible cost and highest possible profit. So they exist, oil companies exist to make money through developing oil and gas fields. Investors or oil companies generally combine technical know-how, so they also employ professionals and experienced professionals in the upstream business. So they combine technical know-how, technology, they develop sometimes also technology, and they buy technology from service companies. They also combine risk analysis and capital management. So they manage, they have certain amount of money, and they need to manage this money among the different projects to assess and select projects to fund. So this is their expertise, the oil company expertise. This is basically what they do. So they combine the subsurface knowledge and project management and risk management to develop oil and gas projects. Projects usually, as you all know by now, require significant capital investment, and they carry some risk. So, and this is what's unique in the oil industry, and this is what constitutes what's coming in the next 3 slides, which is the types of agreements between the state or the country and the oil company. There are 3 main types, there are hundreds of agreements worldwide, of course, and thousands of agreements worldwide. And you can classify usually these agreements into 3 main categories or 3 main types. Number 1, service agreements. I will talk about it first. And then 2 more systems, tax and royalty and production sharing agreements. Service agreements are usually done when you know there is oil underground. So there is no exploration risk. The risk that exists is the operation risk, only operation, no exploration risk. So when you know there is oil underground and there is no exploration risk, usually countries opt to service agreements. So let me give an example on that. After the Gulf War in Iraq, the investment in oil was very low. So the country of Iraq did a lot of service agreements with international companies. So these are old fields. They already know where the oil is. So the type of agreement that they used was service agreement because they know where the oil is, there is no exploration risk. They need companies to come and inject cash, inject money, and inject technology or use technology to produce the oil and the gas. So the type of agreement was service agreement in this case. In Egypt, there are few service agreements as well. The majority of agreements in Egypt, Malaysia, Indonesia, Algeria, most Asian countries are actually most Asian countries and African countries follow the production sharing agreements. And the US, Canada, and Europe follow the tax and royalty system agreement. So what I will do now is I will explain the three different types of agreement, and we can discuss at the end if you want. So again, service agreements are usually done when we know there is oil. So contractor is usually paid a fee. The fee could be in money or kind, I mean barrels of oil per barrel of production. So for example, for every barrel of oil produced, the contractor or the oil company is paid $5, something like that. Sometimes contractor risks some money as it is paid only after achieving a predetermined production target. So in this type of agreements, still a service agreement, but the country would go to the oil company and say, okay, I will not pay you any money until the oil company is capable of producing and maintaining 200,000 barrels of oil per day for the next 3 months or something like that. Then once they achieve that, they will be paid $5 or $10 per barrel or something like that. There is usually a mechanism for cost recovery. So I will talk more about cost recovery in the next slide. But what we mean here is that sometimes in these agreements, in the service agreements, the country would go to the oil company and say, okay, you come develop my oil field, and when you reach 200,000 barrels of oil per day, and you maintain that for 2 or 3 months, I will start paying you. I will start paying you the following. I will pay you what you spent, and on top of that, I will pay you $3 or $5 per barrel. So I will pay you what you spent means cost recovery. So the oil company is recovering its cost. And there are rules to recover the cost. Sometimes the cost is not recovered in 1 year. It is amortized. It is paid in installments over several years. Hence the importance of Capex and Opex. And I will explain that in the next slide. Service agreements are usually applied in known oil accumulations for the purpose of production acceleration and technology transfer. So again, they are usually applied in known oil accumulations when there is no exploration risk. When there is exploration risk, we either do tax and royalty agreements or we do production sharing agreements. Okay, in the tax and royalty agreement, first of all, let's differentiate between what we mean by royalty and what we mean by tax. Royalty is paid from the top line, meaning from the revenue, from the sales of the oil company. Tax means it is the money that's paid to the government from the bottom line. And these are the terms that we normally use, top line and bottom line. So top line is the revenue of the company, which is the sales of the company, the proceeds from selling oil or gas. Bottom line is I take the sales of the company, subtract the costs. The costs here are Capex and Opex, and what's left becomes the profit of the company or the bottom line. So royalty is paid from the top line and taxes are paid from the bottom line. So what happens for every barrel of oil in a typical tax and royalty system? First, there is royalty, and the royalty ranges between, let's say, 10% to 20%, and in every state in the US, and actually sometimes in every region, the royalty is slightly different from one place to another. So the royalty could be 18.25 in one place, 18% in a different place, 12.5 in another place, etc. So this is the royalty that's taken. Whether the oil company is making profit or making loss, the royalty is taken for the owner. Then sometimes there is capital allowance and OPEX allowance. So the deal will be between the country and the contractor or the oil company. The deal will be you will recover your costs up to 37.5% in this case of the revenues from the oil or the gas. The rest is divided into two pieces. Let's say the rest is 50%. So half of it will go to the oil company and the other half will go as tax. Remember that this green is the profit. This green is the profit because we took the royalties out, we took the expenses out, what's left is the profit, and the company pays 40% of their profit, for example, as tax to the host government. So this is the tax and royalty regime or tax and royalty mechanism. The production sharing agreement or production sharing contract or production sharing agreement is similar. There are main differences, and let's explain the production sharing agreement, and I will talk about the differences in a minute. In a production sharing agreement, usually there is also royalty, but the oil company usually doesn't see this royalty. The national oil company, which in the case of Egypt, it's EGPC. EGPC pays this royalty to the Egyptian government on behalf of the oil company or the contractor. So the oil company doesn't really see this royalty, but there is royalty in the system. Then there is maximum cost oil. They call it cost oil, cost recovery, cost gas, of course, and cost recovery gas in the gas agreements. So let's say up to 40%. What does that mean, the cost recovery mechanism? If the oil company spends in a particular year less than 40%, they recover what they spend during that year. So they recover 30%, for example, if they spend 30% of the barrel as cost, they recover 30%. If they spend 60% of the barrel as cost, they are only allowed to recover 40%. And the difference, which is the 20%, will be carried forward to the next year. This is what we mean by cost recovery. So you are allowed to recover up to a certain percentage of the revenue. After that, if the cost is higher than this, it will be carried forward to the next year, and the year after, and the year after, etc. Then the rest is called the profit oil. So this is called the profit oil. Let's say the host government will take 60% and the contractor will take 40%, or 70-30, or 80-20. It depends on the agreement. In some cases, the contractor pays a little bit of tax to the host government as well. It depends on where you are. In the majority of countries, this tax is actually paid on behalf of the contractor, like part of the royalty as well. So the royalty and the tax are paid by the national oil company on behalf of the foreign investor or the foreign contractor. And the reason for that is to minimize is basically to help the investor. So the investor doesn't have to hire a lot of people to calculate the taxes and the royalties and deal with different agencies within the country. They deal only with one organization that, which is in case of Egypt, for example, EGPC or EGAS or Ganubi. Okay. The main difference between tax and royalty and production sharing agreement becomes actually in operation. So in tax and royalty, the oil company operates, makes all the decisions, but they have to get agreement from the regulator. They have to get agreement from the government. So the government has a regulator that regulates the decisions. In the production sharing agreement or production sharing contract, after discovery, the government and the oil company will make a joint venture company, and the joint venture will operate on behalf of the two owners. And the two owners here will be the government and the oil company. So still the government has to control the operations, but they do a lot of operations through the joint venture. In the tax and royalty system, usually there isn't really a joint venture. The oil company operates with its own entity, with its own people. So this is basically the main difference between the two types that we do in exploration. And thank you. I'm sorry I've taken longer than planned, so I've taken like 1.5 hours. And I'm ready for questions, if any. Thank you.
Okay, thank you, Dr. Ahmed, so much for such informative session. But I have some questions from the audience to you.
Okay.
Do you hear me?
Yes, I hear you.
Okay. The first question, what is the pros and cons if we compared between the totally government-owned companies versus the government-sponsored enterprise ones?
Okay. All right. Fully owned companies by the government. So Aramco until today, I think it's 100% owned by the Saudi government. EGPC is 100% owned by I don't want to say the government, but the country, if you will. On the other hand, Statoil Hydro is partially owned by the Norwegian government. So what's the difference between the two? In the national oil company, the appointment of the managing director and the management team comes from the government. Some decisions will be influenced by government decisions. So some people think that this is bad. It actually depends on how you operate. This government direct control of oil companies becomes important also under certain conditions. So, for example, when there is a war, when there is a strategic decision to explore in a particular area, when there is a strategic decision, for example, to invest in a place like Sinai, for example, it will cost a lot of money to invest in Sinai and develop certain places of the country. So you need some government control over companies. So even if we lose money on the short term, there is usually another reason for controlling these companies on the long term. Other reasons for controlling these companies include safety, to make sure that the gas pipelines do not explode, for example. Sometimes we spend a lot of money to make sure that pipelines do not explode. If you are an investor, you may not spend that much money for safety as much as if it is controlled by the government. So there are reasons why governments control their oil companies. On the other hand, in certain countries where governments decided to let go of their direct ownership of their oil companies and decided to float their oil companies in the stock market, whereby anyone can buy stocks in these companies. Government on surface would lose a little bit of control, because actually who hires the management team? It will be the owners of the company. All the owners of the company in the General Assembly will vote on the hiring and firing of the board of the company. Of course, there is more transparency also when the company is listed in the stock market, because any company that's listed in the stock market, to be listed in the stock market, you have to open your books. You have to show where you spend the money and what you have done with all the proceeds and revenues that you made. So this transparency is good. The owners of the company appointing the through the General Assembly, appointing the directors of the company is also something positive. But remember, at the end of the day, countries who have done that, they still control the majority of these companies. So they own 60% or 70% of the company anyway. So they have 70% of the voting power. If they want to remove the board and bring other people into the board, they will be able to do that. So it is basically more control versus less control. In the open economy, you want governments to have less control, but in times for strategic decisions, for example, you want countries to have more control of the oil companies. So I don't want to say, I hope I explained the difference between the two, and I don't want to say which one is better for which country. Which one is better for which country actually is a dynamic question as well. In certain times, it might be the former, in other times it might be the latter. So it actually depends on the situation of the country and at what level of development the country is.
Okay, Dr. Ahmed. The second question, what is the difference between the stakeholders and shareholders?
Same. Here we use them interchangeably. It's the same.
They're the same. Okay. The last question, because we are running out of time, but it will be our last question. What resources or books can be viewed to self-study more about the risk analysis?
Okay. I don't remember names of books now, but in any petroleum economics book, usually they have a chapter on risk analysis. And if you Google it, you will be able to find some. It's not a huge topic, to be honest. Sometimes reading one chapter on risk analysis might be sufficient, and you do the calculations of one or two examples. You go through the different methods of risk analysis. You do the calculations for one or two projects. Then you will understand what's really meant by risk analysis and when to use it and for what types of projects.
Okay, you have a lot of questions, but we are running out of time, as I told before. So thank you so much, Dr. Ahmed, for this session. I hope all of our audience enjoyed it, as enjoyed it actually personally. So thank you so much.
Thanks a lot. Thank you, Dina, and thanks for everyone, and good luck. Thank you.
Okay, thank you. Goodbye, Dr. Ahmed. Goodbye.
Bye.